The moment that your savings hit 100 grand, something changes that no one really warned you about. The exact habits that got you there, the ones that work, the ones that you trusted, well, those same habits will quietly start taking it back off of you. And most people just never really feel it happen. See, what they do is they hand a slice to the market, a slice to the tax man, and a slice to inflation. And they only notice years later when they look up and it's eroded. So before you do anything else, you pretty much have to change the way that you've been playing. Here is exactly what to do and what it costs you if you don't. So here's the first habit that almost completely has to flip. It's the one that most people just walk straight past. Now, the whole time you were building this pot, right, saving hard, topping it up every single month, the real engine wasn't the money, right? It was you, your pay packet, your knack for going out and earning and saving a little bit more. And back when you had like £1,000 to your name, that grand was basically nothing compared to your earning power, right? The amount that you were earning and saving. So you could afford to be a little bit more reckless with it. Chuck the lot in some crypto coin or a couple of racy tech stocks, watch it halve, and you're only down to 500 quid. Now, that's annoying, but a few paydays later, and you're back whole again. You could just out-earn your mistake. See, 100 grand turns that completely on its head. If you lose half of £100,000, you have waved goodbye to 50 grand. And for the average earner or even a high earner, 50 grand of saving is what, 5, maybe 10 years of genuine sacrifice? The holidays you didn't take, the cars you didn't upgrade, all that sort of stuff. You cannot outsave and out-contribute those kinds of losses. You can't outsave and save your way out of a 50 grand hole. Not in any time frame that makes the slightest bit of sense. And it gets worse because losing money and then making it back, well, they're not mirror images of each other. Let me show you what I mean. So say you lose half of your pot. To get back to where you started, you don't need to make half back up again, a 50% gain. You need to make 100% gain. You need to double what's left just to stand still and get back up to the line where you first started. It's a bit like a shop or something like that, sort of putting 50% off of something. You've probably seen this quite often. And then later putting 50% back on. Now, you'd swear in that scenario that you were back up to the original price, but you're nowhere near. A 50% loss needs 100% gain to undo it. And at a sensible 7% a year or something like that, that's the better part of a decade of your life just spent climbing back to the line that you were already standing on if you experience these losses. So look, if you got to that 100,000 threshold by making one or two big concentrated bets, look, maybe you bought crypto at the right time. Maybe you rode a couple of stocks that just absolutely went to the moon. Then honestly, congratulations, right? I'm not going to sit here and tell you that that was a bad thing. You won that poker hand. But the move is now to take some chips off the table, because the thing that got you there will not keep you there, I assure you. Concentration, more often than not, is what builds wealth. Diversification, spreading it wide, is the only thing that lets you keep it. I see this all the time. Once you've got to that point, you've got to take some chips off the table. I see it all the time with people that I work with. And what that does is it usually means if you've got 1 or 2 or 3 or 4 concentrated bets, it moves into something like a global index fund, for instance. It's basically just one fund that spreads your money across thousands of tiny slices of the biggest companies in the world all at once. So the idea is that so no single bet is going to drag you under and take all your money with it. If you do that, what you do is you stop trying to double your money by Friday, and you start building something that quietly throws off 7, 8, 9, 10% for decades. And at that size, at 100,000, that's where the real work happens, right? Because your gains start earning gains of their own. That is compounding. And somewhere around 100 grand, it quietly starts doing more of the heavy lifting than your savings ever did. Boring. And boring is the whole point when you get to this level. And then there's tax, which is where I watch people bleed money without ever feeling a single cut. When you've got 10 grand invested, tax is a rounding error, right? You barely think about it. But at 100 grand, it's the difference between keeping your gains and handing a slice over to the tax man every single year. So you've got capital gains tax. That's the tax on the profit when you sell an investment for more than what you paid for it. Now, that many years ago, I remember was quite a big allowance that used to let you make a fair amount before they even touched you for capital gains. That tax-free slice of gain has now been hacked down to £3,000 a year. And the amount at which you can take in dividends, which is again, your just cut of profits from the companies that you own a piece of before tax bites, that has been chopped down to £500. So if your 100 grand is just sitting in a bog standard general investment account, which is simply just an ordinary investment account with no tax protection wrapped around it, you're now near enough guaranteed to be handing money to the tax man every single year. And it's not a one-off kind of killer blow. It's worse in many ways because it's a slow puncture. You never really hear the kind of tire lose a little bit of air each day, but you just notice eventually that you're driving around on the rim of your tire, right? It's brutal. And every pound you give away in tax is a pound that is no longer for you working and compounding. So over 20 years, that quiet leak doesn't cost you thousands. It can cost you the better part of a six-figure sum over your lifetime. Growth that you just simply never, ever got to see. And the fix is not clever. It's not exotic. It's wrappers, tax wrappers. So again, we've already mentioned it. Max out your stocks and shares ISA. Remember, that is just an account where every bit of growth or dividends that you create held inside it is invisible to the taxman. That's up to £20,000 a year that you can put into that. And if your money's there for the long haul, right, more of a long-term objective, your pension, it has you tax relief on the way in. The government tops up what you put in even before the money started growing. That's a guaranteed uplift on day one before the market's even done a simple thing. Make sure you're using these wrappers. But the one thing that catches the careful people, the sensible ones who never even dream of touching crypto, is the opposite mistake entirely. It's cash. Because plenty of people don't just gamble their way to 100 grand. They get there the hard way, right? Head down, premium bonds, savings account, money in a building society. The number ticking up slowly year after year. And they look at that pile of cash, and I know so many people like this that have this arbitrary level, and they just feel safe because the number on the screen never falls, right? It only just goes up over time as you add to it and it has a bit of interest. That is the trap right there. The number standing still is the exact thing that hides what's actually happening to it. Cash is not a safe asset. It's an asset with a guaranteed loss baked into it, stitched right into it. You just can't see the loss because it never shows up as a number on your screen. So say you've got 100 grand earning, let's say 3% in a savings account, while the real cost of living, your rent, your food, your energy bills, inflation is climbing at 5%. You are going backwards in real terms by 2% a year, every single year, in what your money can actually do for you, in what it can buy for you. Look, it's like standing dead still, but you're on an escalator that's heading down. You feel like you're staying put and you're secure, but you're not. You're losing ground the whole time, smoothly, quietly. and you only clock it when you look up and the floor that you were aiming for is further ahead than you even started. Let's put some real numbers on it. 100 grand in cash on that kind of gap in 12 months buys you what 98,000 would have the year before. Now, that doesn't necessarily seem like a lot, but leave it 10 years and that same £100,000, the number on the screen still reading a pound untouched £100,000, buys you what 81.5 grand buys you today. You've not lost a single pound on paper. The statement looks identical. You've still got all those magic thresholds that you've been clinging on to. And you're getting on for what, 20 grand poorer in the terms that actually count, which is what money can actually buy and do for you. So the key thing here is once you've got your safety net sorted, I'm not saying don't have any cash whatsoever, right? Something like 3 to 6 months worth of outgoings. Somewhere between 5, 10 or 20 grand that you can get your hands on fast. Every pound beyond that is just left sitting, stagnating away, is a pound that's quietly being eaten. And the only way to stop that bleed is to put it to work in things that have, over the long run, comfortably outrun inflation and rising prices. Things like the stock market, bonds to a lesser degree, but they're much less risk. Property, things that are assets that are going to build that wealth, money that grows instead of money that just sits there slowly shrinking while also telling you that it's safe. Now, the absolute key part of all of this is understanding where you should put your money to work that is working for the hardest for you, but also in a place that you know matches your objectives and the level of risk that you want to take, because the stock market isn't for everybody. Which is why I really think you need to watch this video here next, because there is one way to set up your investments to make sure that you never panic and sell your investments at the worst time. So give it a click and I'll see you there so we can get your money working as hard for you as you did for it. See you there.